All righty, guys. Thank you for being here. I will wait just a minute to let people filter in, but we will be starting soon, and we will be talking about volatility contraction patterns. Okay, cool. All right, we are here. Thank you. Thank you, Visridge. Awesome. Let me mute myself so I'm not hearing my own echo. All righty, here we go. So we are talking about volatility contraction patterns today, guys. Thanks so much for being here, and we are going to have some fun. Let's get into it. Volatility contraction patterns. They are from this guy right here, Mark Minervini. He is an amazing trader. You will learn all about him, and I think you'll learn a lot from this. It's one of those trading strategies that's really helped me excel. It's helped me define my edge and really narrow down and hone in on the best stocks in the market in the best sectors and catching the meat of the move while maintaining a really tight risk reward profile. So let's get into it. We'll be talking about just going over a little intro about Minervini, who he is, his trading strategy. We will be identifying the key components of a VCP. There are some very, very pronounced things that we're going to be looking for, and it should be pretty clear to you at the end of the seminar. You'll be able to identify them easily and hopefully trade them. We'll be trading the actual VCP. We'll be going through some trading examples, talking about entries, exits, and managing both the risk and the actual position itself as it moves up, hopefully. We'll cover common mistakes. There are some things that we got to watch out for, and we'll get into that. But in general, there are not too many things you have to worry about, and that's why I really do love this system. One moment, one small technical thing here. All right, Tim, let me know if that helped. Okay. I'm canceling that camera. And we are back. So where was I? Common mistakes. Now we're going to go into case studies after that. We're going to look at some charts, some great examples, and we are going to see what there is to see. There's a lot of good stuff. I'm going to switch over to a full screen. Thanks for bearing with me here. Great. All right. There we go. Okay. And after that, we'll be talking about how to scan for these. So you can do this by yourself. It's a very strict set of rules, and it helps you hone in on the best stocks and just cut through all the chaff there. So after that, we'll do some conclusions and key takeaways, and yeah, it'll be a good time. Some questions after that too. So who's Mark Minervini? He is a former U.S. investing champion in 1997 and 2021. He's posted amazing returns and very consistent returns year after year. This is what it's all about. It's about consistency and honing a system that you can replicate. It doesn't mean that there will always be setups. That's part of this this picky process. But it does mean that when the market is hot, we can strike while that iron is hot and really juice our returns. So he turned $10,000 into 50 million, believe it or not. He is a very accomplished trader from Susquehanna Research. And yeah, his accolades go on and on. I won't bore you too much with them. He's the author of a couple great books. This is my favorite here, Trade Like a Stock Market Wizard. And he's a student of William O'Neill, who has the CAN-SLIM methodology, which essentially combines fundamental analysis with technical analysis. So it's kind of the best of both worlds. Because a lot of times, fundamental traders will fall into the trap of, value traps, right? Why is my stock going down? It's so cheap. Well, somebody's buying it. And at the end of the day, that's what really matters, right? We need to identify demand and more importantly, tightening demand so that we can really, like I said, juice our returns. So what is a VCP? It's pretty simple. A VCP is a contraction or a consolidation pattern where the volatility decreases as the stock prepares for a breakout. It's based on the principle that price action will tighten as selling pressure weakens. So over here, we have a good example. We have one move up and down. We have a smaller move up and down, and it's even tighter here before it breaks out. This is essentially what we're trying to focus in on. We're going to be looking for entries in this real tight little box here, because this will allow us to manage risk right under and capitalize on the big stuff. So why trade them? Because they work. I could talk on and on about it, but I do think that the best the best example is, well, a chart like this. So this is SMCI, and as we can see, it's got a really nice defined base, and what's it doing is contracting in volatility. Each move from high to low gets tighter and tighter as it cooks this base. So on this contraction right here, this is what we're going to be targeting, because it allows us to manage risk very tightly and catch these massive moves. It's a high probability breakout strategy, and that's I don't know, if you're anything like me, if you're anything like me, it's very easy to get burnt on breakouts. To be completely honest, they're hard to trade and they don't have an amazing hit. So one thing to know about this system is it's not an incredibly high hit rate system. It's not like a mean reversion system. You are catching big moves. What this means is that you will get stopped out. Mark Minervini will be the first to tell you he loses half of his trades. But you know what? He's still turned 10K into 50 million. So he's got to be doing something right. Yeah. So we're gonna hone in on that. So key components of a VCP. We got 4 things that we really want to keep in mind. And let's just walk through them here. We're going to use AMR. This chart is from, I believe, 2021, maybe 2022. And it is a great example that I personally traded. I did not catch the whole move. We'll talk about that. But it was a great trade for me, and it's a really beautiful stock and a really beautiful example. So what do we got? We got a prior uptrend. As you can see, this thing was moving very strongly already before it was even, like, just when it was getting on our radars here, you know? So you look for that strong strength in the market because, hey, we want to buy the strong things. We just want to do it in a risk managed way. We are looking for the multiple contractions, as we talked about. The price range gets smaller here because each one of these is smaller than the next. It gets tighter and tighter. And let's talk about why that is. It's important to be able to identify, but it's more important to understand the mechanics behind this. So what we're doing here is we're essentially identifying institutional ownership and accumulation. So what does that mean? It means that they're buying it all in the space, They want the stock and they want to get it as cheap as possible. So it has to surge on very high volume, as you can see. It comes down. Then it comes down, and when they start accumulating here, we want to watch that bottom very closely, and we want to watch where it goes. So it goes up, and you can see that it's not breaking the high. It is in an accumulation pattern. So this is getting it on our radar even more. And now what does it do when it comes down? It does not want to break this low. Why is that? Because it is essentially drying up the supply. The shares that the institutional investors want, they are chasing it a little bit more on this low, on this dip, than they were on this. It shows that it's a stock that people want. It shows that it's something that is under accumulation, essentially. So same thing here. We also really love to see these next highs poking a little bit higher each time. Again, it's just showing the relative strength. It's showing that just like they're accumulating a little earlier, they are, more inclined to push it up a little bit more too. And that just shows that it's, basically supply's running out. So then the next step is that volume drive that we mentioned. As you can see here on the volume, it's a very defined downtrend here. We started with very high volume through all of this, just surging through the daily moving average here. This is a 20 moving average, 20 day or week on this chart. Whatever time frame, that's a great reference point. And what it tells us is that this was running hot. This was exuberance, euphoria, that kind of stuff. And essentially, we don't really want to buy into that. It can work, and I respect momentum traders who can do that. But it's just you have much more potential for failed moves, and that's no fun, right? You get in long up here, sure, you have a nice little move, and then you get cooked down here, and you feel pretty bad when it does something like this. So we want to capture this. We don't really care about this here. What we care about is that it exists and that it shows the strength of the stock. So we have the volume drawing up, and then as it starts to break out of this big base, we see that volume tick up. So what are we looking for there? We're looking for essentially 1.3 to 1.5 times the average daily volume on these breakout moves. And that shows us that it's real, right? That shows us that this is a real move. And a good rule of thumb, because all moves happen on a smaller time frame and move bigger, right? If you wait for the weekly stick to print, oftentimes you will miss your entry. So what we can do is we can use, I like to do an hour. Minervini says the volume in the first half an hour will tell the tale. And I think that's fair. If you see a big, strong surge in the first half an hour, then it just holds that, or, Trade sideways ideally, or up's great too, but that tells you it's real. So that's number 3. And the breakout is what we just discussed, where it surges through. So let's move on to the 3 Ps. I may be repeating myself a decent amount. That's because this isn't a crazy complex system. It's just really important to know what matters. Not a lot of things matter, but they're really important. So we have price. We want to see it getting tighter. Same thing we were talking about, just tightening up. Higher lows and tighter pullbacks. We have pattern, the clear contraction and volatility. Same thing there. And power is the volume through the breakout. Pretty simple here, right? We can all do this. That's what I love about this. It's replicable for everybody, and it's an amazing way to catch these huge moves that otherwise you wouldn't be able to recognize. Because for a lot of people, this is just chop. This is just no funds of chop stuff. And you know what? I love it. I'm all about it because of the system. So how do we trade it? Well, we got some rules here. Entry rules. First off, we have pivot points. That's what I mentioned before, the highest point of the base. You can see it goes straight across, and once it breaks there, it never looks back. Never looks back. So if all things go as planned, you're in a trade at the right place, and you get to ride it until it doesn't work. If it doesn't work, then you'll know fast. The pain is like ripping a Band-Aid, right? And that's what we strive for. So the first thing this does is it conserves mental capital, because we all know we're going to be wrong eventually, but the most important thing is that you don't get super stressed. You don't lose sight of other opportunities. You don't hold losers. You can conserve not only your mental capital but your actual capital as well. So that's definitely one of the strengths of the system. Let's hone in on this chart and see what's going on here. So an early entry is something that Minervini often recommends. It's a little more advanced. What we're talking about, the textbook case, is the break of the base. What you can also do is you can look for this last contraction, this little cup here. And oftentimes this will align with key moving averages. We love to see horizontal moving averages all stacking. That provides a great confluence of support once we flip back into bullish territory over them. So what you can see here is this purple line. That's our 200-day moving average. We also have the EMA that's blue and the yellow EMA that's yellow. What we can do is we can enter on a solid close through that. And then what we do is we put our stop right under that swing low. So that provides very tight risk to a very high reward. If you catch this correctly, which half the time you will, if you follow these rules, then you're set for an amazing trade. And it's very stress-free. That's a huge thing for me that you'll hear me say over and over again. A stress-free trade means that you're in the right spot. So that's the early entry, higher risk reward. And the only thing we really want to avoid on this slide is that we want to avoid chasing big breakouts. It doesn't mean that they won't follow through. But again, this is about honing in that tight risk to high reward. And when something gaps up 8-10%, it's thrown out the window. It takes one failed breakout to just get slaughtered on that. And that's what we're here for. So how do we manage the risk? We talked a little bit about it, but let's really hone in here. Here's the zoomed in chart that we just looked at. And you can see there's the break above. This is sort of the line. That's where we would enter on the low break. And as you can see, it's also a nice flag there. And it has something that we call a trigger bar. It's hard to see here, but this is a very low volume bar at the bottom. And you can see these very often right before the move kind of starts kicking off. So that's something I'll keep an eye on as well. And we can talk about that later at another time too and get really, really granular with it. This is I'm giving you the big bullet points that are most important, but there is a lot of nuance to some of this. And I'd be happy to go in more deeper into this stuff in a future day if people are interested. So this is where we enter. And if we're a little more conservative, we wait for the base break here. But for this example, let's say we enter here. So we put a stop under the swing low, and that gives us a 5% risk. And we are shooting for our first target at the top of the base because it could reject. It could reject. We don't think it will, so we're not going to be exiting the trade completely, but it's a great place to manage risk. Another great thing, especially for this example, is that it provides a perfect opportunity to talk about defining your risk reward to free roll a position. So what do I mean by free rolling? Free rolling is essentially taking profit where the stock has to completely go negative from your entry for you to be even a little bit hurt, right? So if it goes negative, you're still walking away with some profit. This allows you to handle the trades much better emotionally and allows you to really stick in for the home runs. We are all about base hits, which give us a foundation for those grand slams, right? That's what we're about here. So if we put a stop under here, risking $5, we're targeting 15. That's a 3-to-1 risk reward. That's already very solid. What can we do there? We can take a quarter of the position on. That'll essentially protect us from drawdown. If we do draw down into negative, it means that something went very wrong and we should just get out. And that's it's such a weight off your shoulders to be in a trade and it starts to work and you can say, hey, hands off the keyboard, I'm going to let it do its thing. When I get assigned to sell, I know exactly what I'm looking for and we'll pull the trigger then. So there are other ways you can do it. You don't have to do it at this 3-to-1 risk reward. I know some traders who take half of their trade off at 1-to-1 risk reward. Some that take a third off at 2 risk reward. And I think most confident traders and really proficient traders in this strategy, there isn't a one size fits all. It's all about the stock. It's all about the average daily moves. You can look that up with the ADR indicator, and that'll give you a great reference point for how big these movers are. If you're in like a small cap, high flyer type name, really surging on volume, essentially you can probably roll one of these types of 3-to-1 trades, and that can really be great. You love to see a move of 15% over the course of a week and a half, 2 weeks. So yeah, this is why I use this as an example. When it works, it really does work. So let's talk about when we exit. This is the exact same chart, but a little bit higher up. So first rule, sell into strength. We are trading with institutions. Institutions are smart. They sell into strength. If they want to reaccumulate, keep the party going, there will be times where it's just simply mathematically overbought. So how do we define mathematically overbought? Let's think about that. We talked about ADR. That's great. And my favorite way is Bollinger Bands or linear regression channels. This is a linear regression channel. When it's outside of these bands, it's statistically, mathematically, however you want to say it, algorithmically overbought. And we can expect some type of pullback. Does it mean it always happens? No, there are crazy squeezes, crazy moves that just keep going. But we are here for replicability, a system that we can replicate, that we can do day in and day out, or at the very least, year in and year out to provide consistent returns. And part of that is taking profit. So we are outside of the Bollinger Bands on the daily. This is where I would do my first trim if I was really gunning for it and I didn't trim very much. Let's use the example that we trimmed 1 quarter at 3-to-1 risk reward, like we mentioned before. We've re-rolled the trade already. Hands off the keyboard, we're good. Now we're just looking for times where it's overbought to trim, or when it loses a key moving average to sell. There are other ways to manage this too. Some people prefer to scale out at 20, 50, 100%, just in flat percent increments, and that's totally valid. Personally, I think that as a technical analyst at heart, I'm all about trading the chart and not my P&L. So for me, the risk reward is a much better model for me to model where I take gains, where I book profits, all that good stuff. So we scale out when it's overextended on a daily or especially weekly time frame, and then we can always get back in if the chart sets up again. So for this example, we trim here. We're down to half of our position. And this is theoretical. I did not trade this as cleanly the first time because I was much earlier in my trading career back then. But I've learned a lot since then. I think I can share it to you guys so you don't make the same mistakes I did. I definitely got stopped out here, and I don't even think that that's bad. I think that's pretty reasonable to get out here. It closed below averages. So ideally, we're in half the position here. Maybe we get stopped out here. It gaps under the yellow 21 DMA. So honestly, that will probably get me. I forget exactly where it got me in real life, but for this purpose, let's say we got stopped out and we booked a nice profit. We took 15% on one tranche. We took 30-ish% on this one, something like that. And so we're already booking profits and we're keeping this on our watch list. It's really important for these high flyers that you keep them on your watch list, even if they shake you out a little bit, because you know what? The reasons why we bought and the reasons why it went up in the first place are still valid until something major, unconfirms. So what are we looking for here in this consolidation? We're looking for a reclaim of the moving averages. And, we get it here. And this is a valid entry point. We have the bullish cross as well, if you trade those. And then lo and behold, it just continues the party, gaps up and doesn't look back. So what are we looking for here? Say we get back in with a half size position to be reasonable. Well, we can do the exact same thing. Maybe you trim here. Maybe you're a little more risky and you're waiting for the real pop through the actual Bollinger Band. That's totally valid, and that's usually what I do. So that would keep us in here. We're watching in this consolidation, and it's holding these 9 EMAs beautifully. One more, right? Party's on. We're just cooking. So now up here, we have another pop over the Bollinger Bands. Another great time to trim when it's overextended. And what are we watching on the downside? We're watching for those moving averages to catch again. So back into the 9. The 9 is great for a real strong move, but the 21 is where I usually look for actual weakness. As you can see, it cooks the 9 a little bit, but nothing too worrisome. And this candle's nice because it taps it and just rips off of that. So that's a real nice show of strength there. So this would keep me in until this candle right here. Because why? Well, it gaps down. That's no good. Kind of posts a double top too. And then it closes under our key 21-day moving average. So we are out of the trade there. And, if for some reason maybe you only took half off, you only took a third off, everybody's different. That's not necessarily what I'd recommend, but it's valid still, Then I would definitely recommend trimming on this kind of blow off move here where it's just running so hot. It's a crazy gap up. And if not, then you would get stopped out on this candle here. And the same thing. It's a close. It's a smash candle right below or well below the 21-day. So that's a good overview of when we're exiting and, obviously entering and managing the trade as well. So let's go on to some common mistakes here. What we have on our chart is Peloton. And this was, I believe, 2021. And it's a really good example of a failed base break. So this kind of looks like what we were talking about, right? It is contracting in volatility. This one's it's kind of questionable whether this is smaller than this. Doesn't really look like it to me. So that's a bit of a red flag. And the other thing that I really want to hone in on is that there was no major volume pop. Just barely broke over the moving averages. So we are going to be keeping an eye on this if we were looking for a long here, because it did break the base. But honestly, this is the big red flag for me, and this is what would keep me out. So why is that? Why do we want to avoid low volume breakouts? Because I think this is the biggest trap that breakout traders fall into. Because man, these candles can look so good, but if the volume doesn't match, then you have a divergence. You have something that isn't right. There are lots of reasons that a stock can go up, and they aren't all necessarily indicative of a continuous move. So I mean, when it doesn't work, it fails spectacularly. And that's another reason why our risk reward is always very tight in this. If we were in this, we would have a stop under there and we would lose. We take maybe an 8%, 10% haircut, something like that. But this continued to drop over 60% after this. So we need the volume confirmation. Very, very key. We also avoid trading VCPs and downtrends. We are all about finding stocks that are in stage 1 or either stage 1 setups or stage 2 expansions. We do not want things that are under the 50-day moving average. Definitely don't want it under the 200-day moving average unless it shows that pop on volume through, like we saw with AMR. And the last thing is not waiting for long enough for multiple contractions. A lot of people get and they want to jump into these trades. They think it looks really good. Maybe they're like, oh, it's a cup and handle or something. But 1, 2, 3 is okay. 2 is definitely sus. And I like the 5 ones where it's really, really accumulated and showing the incentive to build solid base for shelf. Remember, the bigger the base, the larger the space. So lackluster volume often leads to the failed breakout. We want to avoid that. Stop investing trends. Now we're cooking. So TSM, great example of everything we've discussed. We have a big down move, smaller up move, small down move, small up move, and then real tight price action here. Real tight price action right into the base. And we're drawing these bases basically from these swing highs. You could argue that this is the base too. But personally, when I see this flagging, it's very clear to me that this is where the resistance is. But it's resistance, but it's not rejecting. It's just hanging out. And what are we seeing? We are seeing volume dry up. See, same thing. The arrow shows a general trend of volume going down, whereas on this move up, there were lots of times where it popped up over the average move, over the average daily move, over. Then as we start to consolidate, we see a lot more candles posting under. We do have some outliers, and that's okay. It's not 100%. It's not trading is more like it's more like cooking than baking, right? There's an art to it. There's some nuance to it. If it was all completely uniform, then I would have no job. It would be bots doing this way faster than I could. So the human eye is very important, and we don't want to underestimate that. So we have the volume declining. That's one of our 4 things. We have the price action contracting. That's another. And then we are looking for the breakout. And the breakout is right where we would expect it through the space. And that is our entry, this line right here. So now what do? We basically ride the moving averages on up. As long as it's over this 9-day, I'm in. I'm happy. And then it starts to base again. This is almost a VCP pattern in and of itself, but we won't talk about that right now. Let's jump to the weekly chart, and boom, there you go. This is what happens with these setups. They are absolutely explosive. This one moved 150% in about half a year, let's call it. Crazy velocity, crazy expansion. And as you start booking profits, you can also use the longer dated moving averages. So this is the 9-week moving average, and as you can see, it just works like a charm, right? Multiple taps, just no problem whatsoever. No problem at all. So where would we get out? Probably up around here. We can go back actually and see. This might shake us up, and that's okay. You know, that's still a massive move, and you can always look for reaccumulation and getting right back in. Here's another example, NVIDIA. Good. Yeah. So what do we got? We got all of the hallmarks. I know I'm repeating myself a lot, but I'm doing it on purpose. I swear, guys. It's really important to kind of hone this and just burn it into your brain if you want to trade these, because they're incredibly reliable setups, but you need to be able to recognize. So there's the VCP pattern. There's a contraction, and this one's really exciting because the third is so tight. That's such a tight contraction there. And as it so often happens, it's under a swooping, or it's over, over its swooping 200 moving average. And we have rising short-term moving averages. It's a very good sign. Whenever you have short-dated moving averages crossing over long-dated moving average, it's a conventional buy signal. But what it really tells us is that it's on the move up, right? So our cheat entry is right down there with a stop right under that swing line. And it's got an immediate surge through the base, and then that's your base break entry. Oops. There we go. So we are watching this 21 moving average. It tests it, but what does it do? Boom, strong confirmation that the move is still good. Test it again, boom. And then we start to contract again, but no major sell signals. This candle is tricky, and this could well stop you out. But you know, it's one of those things, right? That's why we don't take it off our watch list. Even if we do get stopped out, there's no shame in getting back in if everything else is on. You know, we are not chasing moves because we love the stock. We're trying to eliminate emotion from this. So honestly, getting stopped out can help with that too. You can be like, hey, I was emotionally invested. Now I'm sitting cash. Now I can look at this with fresh eyes and see, is it real? Is it still going? Well, this one sure was, right? Test the 9 a few times and boom, strong surges, all the way until it finally closes a clean candle way up here under the 21 EMA. And what do? We get out. We book 123% in 6 months. This is why I really love swing trading, because it really allows you to juice returns, and you can just sit in winners. If the winner is working, you let it cook. And it's really good for your mental health, I gotta say, because trading can be stressful, and it's so nice to be just in something that's winning. And if you're not, you feel locked out, you feel like you can't chase. But this is how we define the risk, and this is how we do our thing. So Weatherford here. This is another great example, and it shows that these stocks can continue on the uptrends here. They can reset up in the same stage two expansion phase, and this is what it looks like. Clean volatility contraction pattern. There's our low cheat entry. I'm going to go a little faster because we've talked about this a few times now, and I trust you guys. You guys are competent traders. We got the consolidation. We got the declining volume from this massive stick here, falling down, for the most part trading under this average moving average. And then what do we see? Right at our entry, boom, big volume pop. This confirms the trade for us. We are in. There are some false signals here, like tiny little closes, but nothing with continuity, right? So that's why I always wait for the candle close. This stick is pretty mean. This close at a bit high, wick all the way down, close at the high. So, they do love shaking the tree, especially on these big movers. So the close is very important. If we've defined our risk correctly, we can hold through that. Like I said, our stop is down here. When we get up here, we're taking some off very likely. And then we continue cooking up here, all the way up, riding the moving averages. When we lose this 21-day moving average, we're out. Does it go higher? It does. So what? We booked 71% in 3 months. That's a win. What do? We keep it on our watch list. So reaccumulation pattern. We got the exact same thing, continuation base going on. What do? Low cheat entry. The moving averages are stacked beautifully, and we surge through them in this third contraction. And we are back on in, all the way up, riding these moving averages. You guys know the deal by now. When do we get out? Lost our 21. Easy peasy, 4%. This is very replicable, guys. When you've honed in on the right stocks, they act right. It's really that simple. So let's talk about how to scan for these. It is probably the hardest part because you have to be very picky. You have to consider a few things. The first thing, we don't want to trade small caps. I know it's fun. I know I get the itch too. It's just not reliable. There's so much more ability for these things to get pushed around, to stop you out, to not trade cleanly. And you know what? It's just not what we're looking for. So what we are looking for is a price that's over $10. And we are also looking for liquidity. We want liquidity because big boys want liquidity. They don't really trade stuff without it. I mean, sure they do, but it's not where you get the reliable moves that we're looking for. So for that, we'll screen for average volume over 500,000 shares a day. And by the way, all of these rules are straight out of Minervini's books. Really great stuff. I'd highly recommend, if you like this, to check those out. And well, let's go on to the fundamental stuff. EPS growth, we want to see over 25%, sales growth over 20%, and ROE over 50%. Essentially, we are just looking for the industry leaders because the leaders go up first and they go up the most. A lot of people like getting fancy with it, trading laggards, and it's just not as reliable. How many times have you tried to get cute and buy AMD because NVIDIA is going up, and you're like, what the heck, man? This is BS. We don't want that. We want the best of the best, and that's what we're screening for. Our system allows us to get the best of the best at a discount, and that's what it's all about. And industry rank as well. We just want to trade things in the strongest sectors. There's a lot of ways to look into this. You can do ratio charts. Any sector over SPY, chart goes up, that industry is strong, chart goes down, stay away from it, that kind of thing. And there are also other indicators that can gauge relative strength, and you can just do that on sectors, and that's another great way. Moving on to the technical side of the screening, there's a good amount of things that we want to look for. And the first is that we're in a stage 2 uptrend, like we talked about. We want to see that price moving up before we even consider buying. So stage 2 uptrends, it must be confirmed, and that looks like it's trading above 50 and the 200-day moving average. They're easy to scan for. You can do all of this free on FinViz. If we have time, I might be able to walk you guys through it, although I think I'm running a little bit behind. So we're gonna speed through a little bit because this is kind of in the weeds for some at least. I would recommend taking a screenshot, and I'd be happy to post this in chat as well. But what we're looking for must be in a confirmed uptrend and consolidation period of 3 to 8 weeks, shorter for VCPs and longer for bigger bases. We want progressive tightening. We want to see at least 2 to 3 pullbacks, as ideal, and we want each retracement to be smaller in percentage and shorter in duration than the previous. So we want to see like 10 to 5 to 2 weeks to 1 week to 2 days, and that just shows tightening up of the price action and low volatility entry point, which is exactly what we're looking for. We will see the volume dry up, and we can screen for that by looking for stocks with a volume that's under 50% of the 10-day moving average. There are other nuances. You saw me with my 20-day moving average on my volume. That's kind of a preference thing, but this is the kind of textbook rule from the GOAT himself. So who am I to disagree? And then pivot points. We want to identify the highest point in the base. That's not really something to screen for, but it is something to keep an eye on. That actually should be on the next chart here, the next screen, which is the manual chart review. So we want to look for that. We want to look for the tightening of the right side of the base. This is our TSM example from earlier. And what do we see? We see wide move, small move, and really small move. This is where the money is. This is where the rubber meets the road. And we can define risk against this low here. And we can on the break right here. So it opens here and we're in from open, basically, as long as the first half hour to hour shows that it's real. So that's the key. That's the key. So high and tight flags are also ideal. That's looking like something like Tesla in 2020, where it just surges like crazy and then consolidates way high up, but it bases higher up. And who are we to say that the leader won't keep leading? So that's always great. And then we want the volume spike on breakout. And like I mentioned before, we were looking for over 1.5 times the average volume. And you can choose your 10-day moving average, your 20-day moving average. The important part is that it's a significant uptick. As you can see, significant uptick, and then it continues even higher. It's almost 2 times the average daily volume as the move continues. So that just shows that it's real. So we are just about at the end. So let's just run over a few key highlights here that I want you to leave with, if you leave with anything. First is that the system's about patience and it's about precision. You are not going to have as many trades as some other systems. That's okay. In fact, that's a selling point for me. I think it's very easy to get lost in the weeds, to have too much going on, and to not really be able to juggle. I think that it's much better to have a smaller field of view, really focused on the best of the best. Because what else is worth your money and time, right? We're here to make money, not get chalked out. Always use a stop loss. The system works 50% of the time. When it works, you will book massive returns, 3 times the loss on average, but half the time it won't. And you know what? That's the game we play, to be completely honest. I showed you more examples of winners than losers. I did show you one loser. There are a lot of losers. That does not mean it doesn't work. It just means that we have to respect our stop loss. That is our bodyguard, right? We pay him our stop loss to keep us safe. Got to respect it. And the last thing is practice on historical charts. It's really important to do what we did in here on your own, so you can identify these patterns on your own. You can see how replicable this is and how fractal the nature of the market is. These setups just happen. And why they just happen over and over, it's not magic. It's not some evil algorithm plotting against us. It's just how price action works. When something wants to be bought and wants to go higher, it will surge up, it will accumulate, and it will continue. And we've just kind of broken down how to identify that. So yeah, you do all this, that could be you. Sorry, I was up late and I was having too much fun with stock images, so bear with me. I really appreciate everybody coming by. It means a lot, and I would love to answer a few questions. So I'm going to take a look at chat. If anybody has any questions that I missed, feel free to drop them. I have time for a couple, and then I won't take up too much more of your time. All right, JV says, it looks like you use the weekly candles for your charts and volume. Does this strategy work using daily candles? That's a great question. So this strategy, believe it or not, it works. You'll see it intraday, because like I mentioned, it's all about replicability and it's just how the market functions. This is what price does when it's accumulating for a move higher. So it works on all time frames. I'm a big daily guy. I used a lot of weekly examples just because we were showing some massive moves and the daily wouldn't really capture it. You'd be having to squint in to see the details. But absolutely, daily works on the weekly. It works best on those time frames because they're the most reliable and we're all about reliability. But you will see this pattern on intraday charts, I should say. And that's really cool and really validating to see how these systems play out over and over. Great question. Great question. All right, Mo asks, hey Mo, what are your parameters around how much you trim and when you do? So we talked about it a bit, but just to recap, I think that risk reward is the best way to handle this. You can also trim at flat percentages, 20, 50, 100%. As you can see, the system hits 100% pretty regularly. But it's really about defining your risk to reward. So it depends on every single chart, but you always look for what's my max loss and what's my max gain. You always want to shoot for, I like 3 to 1. That's where I usually take profits off, but I'm a greedy boy. So 1 to 1 is totally valid. If you take off, if you are shooting for lower risk reward targets, you take more off. That does mean that you get less juice in the big moves, but you're safer. And there's always a trade-off, and you got to find what works best for you. It's all about what fits your personality as a trader. Yeah, you're very welcome, JB. Thank you for tuning in. All right. How do you know whether it's a bullish or bearish consolidation? Visage asked that. Great question. Okay. So this is why it's so important to only trade these in uptrends, because more often than not, when you see this pattern playing out in a downtrend, it will simply fail. It'll be a dead cat bounce. That's where so many people breakouts on them. And it feels bad, and most people don't really realize why it happened. Why it happened is because the stock is no longer in a stage 2 accumulation. You have stage, let me pull up the chart. You have the stage 1 where it's accumulating, and you have stage 2 where it's moving up. Then you have stage 3 where it's distributing, and you have stage 4 where it falls off the face of the earth. So often, just like on the way up, it shakes you out, it bounces around. It'll do that on the way down too, and often even more, because that bounces really brutal as shorts get greedy and close out and chase each other, that kind of thing. So that's a really good question. That's why we avoid any of these setups if they do not show that they are in a stage 2 expansion phase. Thank you. I appreciate that. Let me see if there are any more. Looks like that's it. Thank you so much for joining us. I really appreciate this, and I hope to be doing this very regularly every week. I will keep you all posted, and thank you so much for joining. Have a great day.